During the 2008 market crash, Canadian banks were looked up to as some of the best run and most stable in the world. Many investors looked at investing into Canadian banks. In this video, I will share with you my top picks for Canadian bank stocks. Hey, what's going on? It's Chris here from Wealth Awesome. After the 2008 recession, safety and stability were not terms that people have come to associate with banks. Banking institutions lost a lot of investor trust. And with the rapid rise of digital banking, traditional banks are also not as highly profitable as they used to be. This is one area where Canadians have won the geographic lottery. 3 Canadian banks are included in World Finance's list of the best banks, while 6 made it to Global Finance's top 50 safest banks worldwide. The best part, these banks also come with generous dividends and growth. So do your investment portfolio a favor and pick some winners from this list of the best Canadian bank stocks. Stick around until after the list is finished and I'll go over my personal thoughts about Canadian banks and what the future may hold and some certain risks that you might not be aware of. If you get lost or you want to learn more, you can check out the written article about this video on my website, wealthawesome.com. I've included a link in the description below. Before getting on with this list, let me clarify that I've only chosen bank stocks. So this list doesn't include things like financial services and mortgage lenders, since most of them are classified under the same category in several screeners. They're usually in the finance category. This makes the total pool of available securities relatively limited since there's only a handful of sizable and publicly traded banks in Canada. But that's not necessarily a bad thing. A smaller pool means you have fewer securities to screen and judge by your own analysis. Also, as some of you probably know, the big 5 banks are estimated to control over 80% of the banking industry in Canada. Sometimes the term is changed to the big 6 to include the National Bank of Canada. Anyways, here are my top picks for the best Canadian bank stocks. Number 1, you might be surprised, is the National Bank of Canada. Even though it's the smallest among the big 6 banks of Canada, the National Bank of Canada is easily one of the best Canadian bank stocks. It has been growing quite consistently for the past 2 decades, and despite its local focus, the bank has shown remarkable resilience and recovery potential. In the Great Recession, the bank lost about 50% of its valuation by December 2008, but it recovered and grew to its pre-recession valuation before 2010 was over. The recent 2020 drop was almost as brutal, and the stock lost about 48% of its value. It hasn't quite fully recovered yet, but it's quite close. The National Bank of Canada is also a dividend aristocrat and has increased its dividend for 10 consecutive years. It's offering a decent yield right now, though if you get a chance to buy into the company during a market crash, you might be able to lock in a significantly better yield. I chose National Bank as number 1 on this list because it offers a rewarding balance of dividends and capital growth. Its 10-year dividend adjusted capital annual growth rate, or CAGR, is 11%, which is not that far off from the second bank on this list. However, even 1% can make a huge difference when you hold a security over a very long term. And 11% was a very robust growth rate. As per last year's report, the bank had 2.7 million clients, 483 branches, and almost $600 billion in assets under management. The bank generates 55% of its revenues from the province of Quebec, while the rest comes from other provinces and international businesses. Number 2 is a name you should all recognize, which is the Royal Bank of Canada. The Royal Bank of Canada, or RBC as it's better known as, is practically the king of banks in Canada. It's the largest company on the TSX by market cap. Well, it trades places with Shopify now, but it's the largest bank for sure in the company and the most powerful institution for finance. Even though its reign was recently challenged and it was dethroned from the top spot by Shopify, that didn't last too long. The bank is simply massive. It has 86,000 employees. That's about 0.5% of the total Canadian workforce, but also includes international employees. It also has 17 million clients and is operating in 36 countries. Its international presence is quite substantial, and as of 2020, less than half of the assets under the bank's administration are in the country, and only about 10% is in the US. The bulk of its assets is international. Its diverse geography and revenue sources ensure that the bank is both stable and growing. It's one of those institutions that is really too big to fail. The bank has been growing its dividends for 9 consecutive years. Based on its payout in the past 5 years, it has the second highest dividend growth rate among the big 6 banks. But perhaps the best reason to invest in this bank is its consistent growth. Its 10-year dividend adjusted CAGR is about 5.27%. And if the recent market crash hasn't thrown many numbers in disarray, the rate would have probably remained consistent or have grown. And even though everything is going digital, the Royal Bank can claim the largest national footprint based on its 1,329 branches. It's also enhancing its digital banking platform and introducing several amazing investment products like ETFs and other funds that you can invest in. Third up on this list is Toronto Dominion Bank, or otherwise known as TD. If RBC is the king, then TD is the prince. It's the second largest bank by market cap and by the number of branches. With 1,085 branches in Canada, TD is also very close to RBC's growth rate with a 10-year CAGR of about 7%. However, if you consider the dividend yield of the two right now, TD might be the better pick. Another advantage that TD has over other banks on this list is its dividend growth rate. Its 25-year dividend CAGR is about 11%. A higher dividend growth rate would also ensure that you get more payout increases. In 2020, about 1/3 of its premium retail earnings come from the US. Its footprint is not as extensive globally as RBC's, but in North America, TD can go toe-to-toe with RBC. It's the 5th largest bank in North America with 2,308 locations. Its digital footprint is also impressive with 14 million users and growing. The total number of clients outshines almost all other banks on this list since it serves 22.5 million people across the world. And if TD is taking the lead in this, the chances are that it might grow its business faster than any other bank in the country. That could potentially translate into better dividends and faster capital growth and benefits for its investors. Fourth on this list is Canadian Imperial Bank of Commerce, otherwise known as CIBC. CIBC came into being in 1961 thanks to the historic merger of Canadian Bank of Commerce and the Imperial Bank of Canada. Although its capital growth prospects might not be as high as the others, it has always offered a generous dividend yield. Its 10-year dividend adjusted CAGR is 5.28%, but if you can invest a sizable sum in this bank stock now, you'd be able to lock in a pretty juicy yield, and since it's also been a dividend aristocrat for 9 years, the bank is unlikely to slash its yield in the future. Most of its revenues are generated in-house. In 2020, only about 10% of the revenue came from the US commercial banking and wealth management market. One of the noteworthy things about this bank is its resiliency. Despite not being a good growth stock in the past, CIBC showed one of the best recoveries in the industry after the market crash. Recently, its growth has been a bit stale, and it might stay that way for a few more years until the economy and stock market both properly recover from the pandemic. But if you're willing to hold onto the security for a long time, it might outperform many of the flashier but unstable growth stocks you might want to invest in. Its balance sheet is also stable but not very strong. However, the bank has been increasing its revenue steadily for the last 5 years. So even if the stock's performance is not copying it, the institution is actually improving its returns. Fifth on this list is Bank of Montreal. Despite being near the end of this list, BMO is actually the oldest bank in the country, having been founded in 1817. As the name suggests, it was founded in Montreal, and to this day, the bank has stayed true to its roots. It's also an aristocrat and has increased its dividends for 8 consecutive years. But its dividend history stretches way further back in history. The bank has been paying dividends for 191 years, which is mind-boggling. The bank has quite a decent national footprint as well, with 877 local branches. With over $949 billion in total assets as of 2020, it's the 8th largest bank in North America when it comes to assets and has over 12 million customers worldwide. If we discard the market crash and what it did to the bank's valuation, from which it hasn't recovered yet, its 10-year CAGR might rival that of TD. But since it hasn't been able to recover from the crash quite as well, I've placed it fifth on my list here. The dividend yield isn't particularly impressive, but if you consider its capital growth history in the past 2 decades and how the bank can replicate it, it has the potential of being an excellent long-term holding. The bulk of the company's revenue, 58% of it, is generated within the country, with the US coming in at second at 31%. Only 11% of the bank's revenues came from its international business. Its balance sheet, though, is strong, its annual revenue growth is impressive, and the bank managed to maintain a pretty steady net income margin for the past 5 years. Strongly considered buying the stock if it dips again in the near future. Sixth on this list is the Bank of Nova Scotia, or better known as Scotiabank. If we had arranged this list by dividend yield, Scotiabank might have topped this list. It's the third largest bank in the country by market cap and has over 900 branches across Canada. It serves about 11 million retail, commercial banking, and small business customers in the country. Impressively enough, the bank is offering services to just as many international customers. It has around 1,400 branches outside of Canada, almost double its domestic footprint, which is very impressive. Outside Canada, the bank generates more than 2/3 of its total international revenue, surprisingly in Latin America. The Caribbean and Central America make up about 1/4 of the total international revenue, while the rest comes from Asia. This impressive global footprint doesn't help its investors with their capital growth prospects much though, but the primary reason to invest in this stock is the very solid dividend yield. Unfortunately, it is also the slowest recovering bank after the 2020 crash. If you want to lock in a good yield though, this time might be ripe. Once it recovers, the yield would shrink and next year's payout growth might not be as generous. Last on this list is a bank you might not have heard of. It's the Canadian Western Bank. The main reason though it's on this list is because of its impressive dividend history. It's been growing its dividend for 28 consecutive years and is the oldest aristocrat in the financial sector. It has a history long enough to be considered a dividend aristocrat across the border as well, which is not an easy feat. The yield is decent and the payout ratio is very secure, but that's about it. Its share price history is shaky, and its 10-year CAGR is just 3.48%. The company operates primarily inside the country, and almost 2/3 of its business loans come from BC and Alberta. The bank does more business with commercial clients than it does with retail clients, which is the reason you might not have heard of them. Thankfully, oil and gas don't make up much of its loan portfolio because that's one area where the bank would probably pick up the most losses in the coming years. So I said at the beginning of the video, I'd go over my take on Canadian banks and their stocks. So I'll just quickly go over my thoughts. Overall, I think Canadian banks are very prudent and less prone to huge financial collapses like we saw in 2008. Our lending measures are a lot stricter. We just seem to have in place a more conservative structure. That being said, maybe the growth prospects aren't as high as, say, an American bank. And there are also risks in the Canadian sector as well. All Canadian banks are very highly exposed to mortgages, and we have a very high debt to income ratio for Canadians. So if something were to happen where there might be a housing crisis or something like that and a lot of bad debts were to come out of it, the banking sector could be in trouble, but I don't think it's a very high risk, just something to be aware of. So overall, I will give Canadian banks a thumbs up and a recommendation to go ahead and invest in them. And if you're looking to invest in Canadian stocks, I think the best way might be Wealthsimple Trade because they do offer buys and sells for free, similar to Robinhood in the US. If you're interested, I put a link in the description. You can have a $10 sign up bonus. Alright, since you made it this far, make sure you like and subscribe to the channel. I put out new content every single week, so don't miss out on the tips. And if you like this content, make sure you check out the blog wealthawesome.com. It's one of the fastest growing blogs in Canada, with thousands of Canadians visiting it every single day. I put a link in the description as well. And as always, thanks for listening.